This is episode number 76. Today is Saturday, September 19, 2020. Cash balance plan part 10. An overfunded or overfunded plan. What happens? This is a 39.6 Facebook Live Finance Show. The show that teaches high earners like yourself how to make your money work for you, so you don't have to work for your money. We talk general investing, taxes, real estate, retirement accounts, syndications, Airbnb, even the car you drive. Today we're on episode number 10 of our cash balance plan series. How do we deal with an overfunded or overfunded plan? These are the most common questions, particularly the underfunding of a plan when you don't meet your goal. Okay. So first of all, it's really hard to find good information online about this. If you're creating a new plan, then you definitely want to be using an actual rate of return crediting model or a market-based return crediting model so that you have a lot of safety in terms of being overfunded or underfunded. For example, if your plan has a goal of like 5% and a cap of crediting at 6% with an actual rate of returns or market-based crediting cash balance pension, then as long as you receive 0 to 6%, you have this very wide range of being safe for that year. You're not overfunded and you're not underfunded. Okay, if you're using the fixed crediting rate model where you have like a 4% crediting per year, you have to get exactly 4% every year, or else each year you'll be overfunded or underfunded. That's a lot more complicated to deal with. That's what you'll find a lot more information on, however, when you look things up online, because most plans that are open historically were fixed rate crediting models, because market-based or actual rate of return crediting models are a lot newer. They're so much safer. Okay, so let's just take, for example, the regular fixed rate crediting model. Your goal is 4% and it earns 5% in the first year. So you're overfunded by 1%. That 1% will stay in the account overfunded. So there were some earnings that the participants don't really get credit for. So they took on some risk they didn't necessarily need to take to get that 4%. But then the following year, it gets 3%. So then you could take the extra from the first year, offset the loss. And so now you're at 4% per year. So now you're back to even. I understand that it's not going to be exactly even because you have more money in the second year than you did the first year, and adding 5% and adding 3% in two subsequent years does not exactly equal 8%. But I'm just simplifying this. Now, if you are underfunded, we're going to go with that regular fixed rate crediting model. So let's pretend you get 2% in the first year. The goal is 4%. So I've seen various things online about how to replace this. Now, in the plan documents, you should determine within what amount of period the plan will correct an underfunded status. And I believe that you're allowed to have up to 7 years, at least per one reference. I've seen different pages refer to different amounts, but like 3 years or 5 years. But I think the most you can choose is actually 7, like a 7-year amortization of that deficit. So for example, let's pretend you have $100,000 in the plan and it's supposed to get 4% the first year, and it ends up getting 2%. So it ends up being at $102,000. So you're short by $2,000. You could amortize that deficit of $2,000 over a period of time. Let's say you divide it over 7 years. So you have to then contribute $2,000 divided by 7. Okay, so that's going to be, let's just say, about $300. So you have $300 extra you'd have to contribute the second year. So the second year, instead of contributing $100,000, you'll contribute $100,000 plus $300. So not a big deal. It's still slightly underfunded. Okay, so the next year, let's pretend you get exactly 4%. So that year you were even Steven with your goal. So you still have to put in the $100,000 for the third year plus another $300. So that $300 deficit carries every single year for 7 years. However, let's pretend in the third year, you end up getting 6% on your money. So that 6%, and you've had $200,000 or $300,000 in there at this point times 6%, that's $18,000. And your goal is only to get 4%, or $12,000. So now you have $6,000 extra. That $6,000 extra can offset any residual deficit that you had. And now you're actually a little bit overfunded. Okay. So the overfunding can be used to offset subsequent losses. And if you're in a deficit, you can amortize that deficit over a certain amount of time. Part of the problem with this is if the pension is in underfunded status and somebody leaves the pension, Kate just walked by in the background. If you are underfunded and somebody leaves, remember they have to have at least a preservation of capital requirement in general, but they have to not be in a deficit for the years that they were in there. So if they leave in the third year, those first 2 years, it got credited with 4% for each of those years. You would have to make sure they got $208,000 for the first 2 years, plus whatever they put in for the third year out. Okay, the crediting happens at the end of the third year, so they won't get any credit for returns on that third year because it hasn't been credited. It's still at a 0% return. So if there is a shortfall, okay, you have to have a way that it doesn't impact all the other participants in the pension, because then ultimately they're getting away with money that other people's money, OPM. Okay, so there are a lot of ways to do this. If you're a partnership, you can keep whatever that deficit is. They have to take that money out and meet the rules of the pension. But if they're taking out an extra, let's say $10,000 that they didn't earn, then you have to be able to claw back $10,000 out of their subsequent compensation to replace that from the pension. Okay, so you could take that out of their last paycheck. You could take it out of accounts receivables and future earnings. You could take it out of, if they're leaving a partnership, they often are selling their capital contribution back, their stock ownership in the partnership. And let's say their buy-in was $100,000. Well, you could just give them $90,000 back and you keep $10,000 to put back into pension. That way, everybody is kept whole and you don't violate the pension requirement of them getting out whatever they needed to get to make sure that they weren't taking out less than they should have. Now, if you are in a variable crediting or actual rate of return market-based crediting model, you just have to stay above 0%. Okay, now our asset allocation is 40-60. Now that 40-60 allocation historically has only had not even a 10% drawdown in 1 year as the maximum drawdown. I think it's like 8 point something, let's say 9%. So that's not that big of a deal. Let's pretend in the first year of the plan, it loses 9%. And so you're below 0. Now they could require you to replace some of this in the subsequent year, but it's not going to be a lot. If you're allowed to amortize this over 7 years, then you're only having to put like 1.4% more. So if you were putting in $100,000 the first year, then it could be like $101,400. Okay. Now going forward, if you have any gains, you can offset those losses. Now, I don't know if you actually have to offset or amortize that underfunding the very first year with a variable rate model. I talked to my actuary. We had to sign up for a 3-year allocation, which is pretty common, same amount for 3 years. And I don't recall him saying that if there's a little bit of a shortfall in the first year, that we would actually have to replace that in the first year or any percentage of it. Because over a 3-year period of time, the likelihood of staying below zero with continual contributions is pretty low. So I don't think that is nearly the risk that it is with the fixed rate crediting model. And so, we basically signed up and he said, pick your amount for the next 3 years, and that's what it is. And I've heard some people tell me that after the actuarial analysis was done, they actually were notified they could put a little bit extra this year after our first year when we opened it last year, but not due to any shortage. It's just based on the actuarial analysis, because our election period for contributions was 2020 this year through 2022. We were also able to put in 2019 as a one-time contribution when we opened it, but the 3-year planned allocation is 2020 through 2022. So once we committed to that number, we're on the hook for that for 3 consecutive years. Now, what if it's overfunded? So, in the fixed rate crediting model, if it's overfunded, you can hold on to that potentially and cover underfunding, but it's still overfunded. And if you are to close out a pension plan, that can actually be a bit of a problem, because then you would give out all that money to the people, and they would potentially get more than they're supposed to get based on the actuarial analysis. So that can be a problem. What you can do to deal with that is you can give extra contributions to the 401ks or pension plans of all the non-highly compensated employees in that year, and by increasing that contribution, then you can take out a little bit more yourself too. And the same goes for just on a year-to-year basis. I don't know if pension can be too overfunded if you just keep on running from year to year, but I think that is a possibility. And so possibly you might have to, you might get into a situation where you have to give more to your non-highly compensated employees. With the variable rate crediting model, again, this is over time with an allocation like 40-60. If we keep it open for 7 years, 10 years, the likelihood that we're going to be above our cap is not super high. If it is, it's probably not going to be by much. And if that is the situation, then we would have like 2 options. One would be we could decrease contributions potentially in a subsequent year to allow us to get credited with a little bit extra. We also could increase more to the non-highly compensated employees, so we could get more in as a one-time situation. And that would keep us in compliance. So we have to keep in compliance every year, year to year. The actuary has to always run the numbers. And if you have an overfunded pension and you leave your own group, this is also a problem, because they can't necessarily give you more than you have been credited with, even though part of those extra earnings are yours. So if you're a member and you're in a deficit, the company doesn't want you to take money that's not yours. If you're a member of the pension and you have a surplus, you don't want to leave and not get your money. So it works both ways. And so if you were to take more out, then the company can, if you take more out, then you're not in compliance with the pension anymore. So that's a problem. They potentially could give you more money outside the pension, but this is all up to how your plan documents are created to make sure that you get kept whole, that all the rules are met. So if the pension's overfunded, they could just give you extra compensation on your last paycheck, to account for that surplus that's ultimately going to go to somebody else. So it's a lot of bookkeeping to do all of this, but because contribution amounts are often variable from person to person, it's worth it. If it were that every single person put the exact same amount in, like $50,000 for every member, that would be a lot easier. You just have a straight percentage of the pool, and it'll also be easier if everybody joined all at the same time. But that's just not the reality of how these things actually work in real life. Okay. So I think that covers it. It is complicated. I wish I could give very, very clear examples of what it is, but every pension can be run differently depending on the actuary and how it's designed, and different actuaries often come up with different answers to the same question. So unfortunately, this stuff just isn't as cookbook as we'd like it to be. The calculations and things are just so complicated. But that's why it's really important to have an actuary who's experienced, knows what they're doing, that you feel like you can work with long term, because you don't want to put your pension out of compliance. That's just going to be an unbelievable amount of headaches, costs to deal with something that was just designed to help you save on tax. So, all right. Have a great day. Until tomorrow, episode number 77. Have a good one. This is, again, only for my entertainment, your entertainment, not for legal, professional, financial, accounting, any other advice. All right. Until tomorrow, take care.